All right, chapter 10, but really it's chapter something else, as you probably have already figured out. Um, okay, but regardless of the chapter number, the chapter content is the same. We're going through relevant costs for managerial decisions, and we are going to cover um, use relevant costs and benefits for short-term decisions. This entire most of this chapter has to do with short-term decisions. Okay, we will do service using or price of service using time and materials. We'll do that at the very end. So one of the very last lectures we do will be that. But we're going to have quite a few lectures. I'm going to do make or buy decisions in this particular lecture. Then we're going to talk about sell or process further, right? So you think of milk. I think we used that in a previous example. We can turn milk into yogurt. So do we do we sell our milk as it is, or do we process it further and turn it into yogurt? And instead of selling milk, we sell yogurt. Determine sales mix, constrained resources, right? So if I have, I don't know, if I have a very popular product that makes a lot of money, do I only want to sell that particular product, or do I want to sell other products that may not be as profitable but are necessary to sell in order to have customers come into our store? So that's sales mix. And then obviously, if I have limited shelf space, how do I determine what products I put on the shelf if I do have limited shelf space? Okay. Then we're going to talk about business segments and whether it makes sense to eliminate certain segments. We are going to talk about keeping or replacing decisions, right? So if I have a machine and it's relatively old and it's not the most efficient thing in the world, what do I like? What do I look at to consider replacing the machine, right? So obviously, if you think about your car, it would be awesome to buy a new car every 3 years, but is that the right decision? And how do you think about what factors go into whether you should replace a machine or not, or a building or a car? All right, so we'll get through that. Then we're going to talk about product selling prices. And again, there are short-term selling prices and long-term selling prices. I think in this chapter, we're going to really focus on the short-term selling prices. And then we're going to evaluate special offer decisions. And I want to say we've even covered some of that in previous chapters. All right. So, describe the use of relevant costs and benefits for short-term decisions. I don't know if I want to do that or not. I like this slide. I like this slide. In general, okay, in general, when we're trying to make decisions, we really only want to think about what are the, there's a baseline. And then if I make a particular decision, what additional revenue am I going to make? And what are the additional costs that are going to incur? And therefore, what's the incremental income? So we could have, let's see, no, of course not. I could have scenario, maybe I do it down here. I could have scenario A, okay? The incremental revenue could be 100. The incremental costs could be 30. And therefore the incremental income is 70. I could have situation B where the incremental revenue is 120, the incremental costs are 30, and therefore the incremental income is 90. Okay, so I do nothing and I earn nothing extra, or I can choose alternative A and make $70, or choose alternative B and make $90. And the obvious rule is whichever one is going to increase my income is going to be the one that I decide to go with. And so obviously in this scenario, I'm going to choose scenario B. Okay. Relevant versus irrelevant costs. Okay, this is a hard one for most of us to get over, but sunk costs are things that we don't really have any control over, right? So, man, if I spent $100 million, and I'm trying to decide whether I should spend another 30 to pursue this or to finish this opportunity. If I spend another 30, the total cost is 130 million, right? And let's say that the incremental revenue, so I'm going to call this cost, and the incremental revenue, if I complete this, is 100 million at the moment. So things have suddenly changed, and I'm only thinking that I can generate 100 million in revenue. Okay. The question is, should I finish? Should I finish the project? Right? And at the end of the project, the total cost would be 130 and the revenue would be 100 million, right? So the sunk costs, what we're saying is these are irrelevant, right? I have no control over that. Those have already occurred, I should say. And therefore they are irrelevant. And so again, scenario A, I do nothing, right? I just shut everything down. There is no incremental revenue. There's no incremental costs, and therefore no incremental income. However, scenario B would be I finished the job, therefore 30 million in incremental costs, right? We said we needs another 30 million to finish. Then I would have 100 million in revenue. And therefore, if I finish the project, I'm going to generate 70 million in income. So I'm thinking in this particular instance, even though the entire project is a terrible idea, it doesn't mean that as of today, I should shut it down. Because as of today, the best path forward would be to finish the project so that I can get my hands on this 70 million of income from today moving forward. Okay. Obviously, obviously, there could be opportunity costs. So opportunity costs are if I do spend this 30 million, right? If I do spend that 30 million, I am going to get the 100 million. But what other things could I do with the 30 million instead of this particular project? Okay. So I have to take 30 million from something else and sink it into this project. The opportunity cost is what I can't do with the 30 that I would have done not pursuing this project. Right? So if you think about your college education, the opportunity cost of getting an education at the moment would be not having a full-time job at like Home Depot, right? So you can literally just drop out of school and go work some job that doesn't require a college degree. So you coming to school and being a full-time student, the opportunity cost associated with that is the money that you are not making by being in the workforce currently. Okay. And then avoidable costs, those are things that you can get rid of if you don't make a decision. And usually when we're thinking about avoidable costs, we're always talking about fixed costs, right? So the factory rent. If I don't make any products, if I choose to stop making products, I probably still have to pay the factory rent. So avoidable costs are if I don't do something, what costs go away? Okay, like I said, I'm going to do the make or buy decision, right? So scenario A would just be I'm going to make something myself. Scenario B is I'm going to pay somebody to make something for me. Okay. In this particular example, Fast Track currently buys a key part for $1.20 per unit. The cost to make the part is $1.05, and it includes direct material, direct labor, and incremental overhead. So the question is, do we make this ourselves, or do we continue to buy it from somebody else, right? So we were just saying that if I want to make this particular product, we're going to spend 35 cents per product in material, 50 cents in labor, and then 20 cents in variable overhead. So the total cost to make it would be $1.05, as opposed to buying it from somebody else, $1.20. In this particular situation, we're basically saying, hey, listen, it's going to save us 15 cents to make this in-house. And so theoretically, we should make this in-house. Okay. But what if it's the case? What if it is the case that we have all sorts of things that we're making? And if we were to start making this particular key part, we couldn't make something else. Okay. So what we're not really focused in on this particular are the opportunity costs. And so I would just kind of keep that in the back of your mind when you're doing the homework. I agree that making this particular part is less expensive than buying it. Okay. But if I was making, I don't know, 50 cents in profit on some other product, and I couldn't make that product because I was now making this key part, then I'm losing 50 cents of profit in order to make this for 15 cents less. Overall, that seems like it's a bad decision for me because, again, I'm giving up the 50 cents to save 15 cents. And therefore, I'm really only, in fact, I'm worse off. I'm losing 35 cents, even though it's less expensive to make it ourselves. Just because it's less expensive doesn't mean that that's still the right decision.